How much money do you really need to start trading? Is it $1,000, $5,000, or do you actually need tens of thousands before you even think about entering the market? The truth is, most people delay starting because they believe trading is only for rich people. Social media shows traders with luxury cars, 6 monitors, and massive profits, which creates the illusion that without a big account, you have no chance. But in reality, the amount of money you need to start trading depends far more on your goals, your strategy, and your mindset than on any fixed number. Let's clear one thing first. You do not need a lot of money to start learning trading. What you really need in the beginning is not capital, but skill. Trading is a performance-based business. You are not paid for how much money you bring. You are paid for how well you manage risk and make decisions. A person with a $500 account in strong discipline will always outperform someone with $50,000 and no plan. This is why most beginners lose money, not because they start small, but because they start unprepared. The biggest mistake new traders make is thinking in terms of profit instead of thinking in terms of survival. They ask, how much can I make, instead of how long can I stay in the game? The market does not reward impatience. It rewards consistency, risk control, and emotional stability. If you cannot manage a small account, you will never manage a big one. In fact, a small account is actually an advantage in the beginning because it forces you to respect risk and focus on learning instead of gambling. Another important reality is that there is no universal number that works for everyone. Someone who wants to trade full-time and live off trading will obviously need more capital than someone who just wants to build a side income or learn a new skill. Your lifestyle, your expenses, your market, and your time frame all change the answer. So instead of asking, what is the minimum amount, the better question is, what is the right amount for my situation? Here is the mindset shift that changes everything. You should treat your first trading account as tuition, not as an investment. This is your learning phase. Just like going to university, you are paying to gain skills, experience, and emotional control. The goal of your first account is not to get rich. The goal is to survive long enough to become consistently profitable. If you go in expecting fast money, you will blow the account. If you go in expecting to learn, you will build a foundation that can make you money for the rest of your life. So, before we even talk about exact numbers, platforms, or markets, you need to understand this one core truth. The real cost of starting trading is not money. It is discipline, patience, and time. Capital only amplifies who you already are. If you are reckless, more money will just make you lose faster. If you are disciplined, even a small amount can become the starting point of something big. Now let's talk real numbers, not fantasies. Technically, you can start trading with as little as $50 or $100. Many brokers allow this, and yes, you can place real trades with that amount, but realistically, this level of capital is only useful for one thing: practice with real emotions. You are not building wealth with a $100 account. You are training your psychology, your execution, and your risk management in a live environment. If you want a more practical starting point, something that actually allows proper position sizing and realistic growth, the sweet spot for most beginners is between $500 and $2,000. This range gives you enough flexibility to manage risk correctly without feeling forced to overtrade. You can risk 1 to 2% per trade, survive losing streaks, and still stay in the game long enough to improve. This is where real learning happens. Now, let's be honest about expectations. With a $1,000 account, even a very good trader making 10% a month is only making $100. That is not life-changing money, and this is where most people quit because they realize trading is not an instant escape from their job or their financial problems. But this phase is critical. This is where you prove to yourself that you can be consistent. Once you can grow a small account steadily without blowing it, scaling becomes a mathematical problem, not a skill problem. For people who want to take trading more seriously, meaning they want to aim for meaningful monthly income, the realistic starting capital is usually between $5,000 and $10,000. At this level, even conservative returns can start making a noticeable difference. A 5% month on a $10,000 account is $500. That is still not luxury money, but it is real money. More importantly, it teaches you how your emotions change when the numbers become bigger. And here's a key point most gurus will never tell you. The size of your account should match your emotional capacity. Some people cannot handle seeing a $20 loss without panicking. tanking. Others are fine losing $500 in a day if it follows their plan. There is no best amount, only the amount you can trade without making emotional decisions. If your heart rate spikes every time you open a position, your account is too big for your current level. So the real answer is simple but uncomfortable. You need just enough money to trade properly, and just little enough that losing it will not destroy you mentally or financially. Start small, prove consistency, then scale. Trading is not about how fast you start, it's about how long you can stay in the game without blowing up. The amount of money you need also depends heavily on what market you choose to trade, because every market has different rules, costs, and risk levels. This is something most beginners completely ignore, and it leads them to start with the wrong expectations in the wrong place. If you were trading stocks in the United States, especially as a day trader, there is a major rule called the pattern day trader rule. This rule requires you to have at least $25,000 in your account if you want to day trade stocks more than 3 times in a 5-day period. That means for most people, stock day trading is simply not realistic at the beginning. However, if you are doing swing trading or long-term investing in stocks, you can start with much less, even a few $100s, because you are not limited by that rule. Forex is one of the most accessible markets for beginners because it has low entry barriers. Many brokers allow you to start with a few $100s and use leverage to control larger positions. But leverage is a double-edged sword. It can grow your account faster, but it can also destroy it faster. This is why most new Forex traders blow their accounts, not because Forex is bad, but because they misuse leverage and overtrade with emotions instead of logic. Crypto trading is similar to Forex in terms of accessibility. You can start with very small amounts, sometimes even $50. The problem with crypto is volatility. Prices move very fast. News impacts the market heavily, and emotions are amplified. For beginners, crypto feels exciting, but it is also one of the easiest markets to lose money in if you have no risk management system. Futures trading is the most dangerous for beginners, even though many people are attracted to it because of the profit potential. Futures require margin, and one bad trade can wipe out a large portion of your account. Realistically, futures should only be traded once you already have experience in other markets and a solid strategy. So the market you choose directly affects how much money you need. Stocks require more capital, but are more stable. Forex and crypto require less capital, but demand more discipline. Futures require experience and emotional control. There is no best market, only the market that fits your personality, your risk tolerance, and your financial situation. No matter how much money you start with, the single most important factor that determines your survival and eventual success in trading is risk management. You can have a $10,000 account or a $100,000 account, but if you risk too much on a single trade, it won't matter. Most beginners make the critical mistake of focusing on profits first and risk second, and that's exactly why they lose. A basic rule for beginners is to risk no more than 1 to 2% of your account on any single trade. That means if your account is $1,000, the most you should risk on a trade is $10 to $20. This sounds small, almost frustratingly slow, but it is what keeps you alive. The market is unpredictable, and even the best traders lose trades regularly. Controlling risk is the only way to make sure one bad trade doesn't destroy your entire account. Risk management isn't just about money, it's about emotions. When your losses are small relative to your account, your mind stays calm. You can follow your trading plan, avoid panic decisions, and stay consistent. When your losses are too big, fear and greed take over. You start revenge trading, over-leveraging, and breaking your own rules. That's when accounts get blown. Another part of risk management is position sizing. Beginners often trade too big for their account size because they want fast gains. But trading bigger than your account can handle is like trying to drive a sports car before you've learned to drive at all. Start small, master the mechanics, and then increase your position size as you gain experience. That's how real traders grow their accounts safely. Finally, risk management also includes having a plan for drawdowns, periods when your account decreases. Every trader experiences them. Expect them. Prepare for them. Accept that losing trades are part of the game. The money you start with should be enough to weather these drawdowns without breaking your rules or panicking. Trading is a marathon, not a sprint, and accounts survive longer when risk is managed wisely. If you get this part right, start small, control risk, size positions properly, and survive drawdowns, drawdowns, then no matter how much money you began with, you are building the foundation for long-term success. Once you've mastered trading a small account, the next step is scaling. Scaling doesn't mean rushing to deposit more money. It means gradually increasing your capital as your skill and confidence grow. The key principle is simple. Grow your account only when you've proven that you can consistently make profits while managing risk. Jumping into a bigger account too soon is one of the fastest ways to blow up even a previously successful trader. Here's a practical example. Imagine you started with $1,000, and after several months, you've learned to make 5% per month consistently. Instead of immediately putting $10,000 into the market, you can slowly increase your positions as your account grows. This way, you're scaling in a controlled environment. Each step is backed by experience, not hope or impatience. This is how small accounts eventually turn into substantial ones without unnecessary losses. Another important aspect of long-term success is mindset. Many traders get fixated on how much money they need to start or how fast they can make it. But the reality is that the market rewards patience, discipline, and adaptability. Learning to manage emotions, stick to a plan, and accept losses as part of the process is more valuable than any minimum deposit requirement. Big accounts don't make great traders. Great traders make big accounts. Finally, think of trading as a lifelong skill, not a get-rich-quick scheme. The capital you start with is just a tool for learning. The real wealth comes from your ability to apply your strategy over months and years. Some of the most successful traders started with very little, but scaled carefully over time. The difference between success and failure is not the starting balance, it's how intelligently you trade, manage risk, and evolve with the market. So, to answer the question fully, the money you need to start trading is enough to survive, enough to follow proper risk rules, and enough to learn without panic. Start small, focus on skill, respect risk, and scale intelligently. That is the path to turning a modest trading account into a potentially significant income over time. Before you deposit a single dollar, let's summarize the most important points so you start trading the smart way. Start with what you can afford to lose. Trading is risky, and your first account is a learning account. If losing it would cause stress or financial trouble, you started too big. Small accounts teach discipline and patience, qualities far more valuable than any dollar amount. Focus on learning, not earning. Treat your early trades like tuition for a school you pay with real money. The goal is to gain experience, manage emotions, and understand market behavior. Profit comes later. Survival comes first. Match your capital to your market. Stocks, Forex, crypto, and futures all have different requirements. Don't force yourself into a market just because it looks glamorous online. Pick one that fits your account size, personality, and risk tolerance. Prioritize risk management. Never risk more than 1 to 2% of your account on a trade. Learn position sizing, prepare for drawdowns, and never trade emotionally. Risk control is the single biggest predictor of long-term success. Scale gradually. Once you prove consistent profitability with a small account, slowly increase your capital. Don't chase bigger numbers too fast. Scaling is about patience and discipline, not reckless ambition. Mindset is everything. Trading is not about how much money you start with. It's about who you are as a trader. Patience, consistency, and emotional control matter more than account size. Big money follows skill, not the other way around. Remember, there is no perfect amount to start trading. The right amount is whatever allows you to learn safely, trade calmly, and manage risk properly. A small account today can become a large one tomorrow, but only if you respect the process. Trading is a journey, not a lottery ticket. Start wisely, focus on skill, and the money will follow. This is the reality most beginners ignore. You don't need hundreds of thousands to start. You need the right mindset, discipline, and enough capital to survive while learning. Everything else, profit, growth, and success, comes after you master those fundamentals.